Well, greetings, test takers. This is Dean Tenney coming to you from my studio in fabulous Las Vegas. Today, it's time for another explication of a practice test. This is our second explication for the Series 65, practice test number 2. And before we get underway with that, just like to get some housekeeping out of the way. We have a collaboration with TestGeek Exam Prep LLC and its managing member, Brian Lee. And what's nice about the collaboration is you as a viewer or subscriber to the channel are getting access to what would be a paid supplement, the exam we're about to explicate. And you get access, we also have for you as a viewer or subscriber, a 20% discount on all TestGeek Exam Prep LLC's supplements. They're paid supplements. Neither Brian nor myself, this is a free supplement, the YouTube channel, to your paid study materials, and his is a paid supplement to your paid study materials. We're not trying to replace those. We're just trying to give you some additional resources. Anyways, on the paid supplements, if you'd like a copy of the exam we're about to explicate and an answer key and rationale, I'll be giving you my rationale, my spin on Brian's question. So I'm sure some of the rationales will be the same as what Dean said, probably some little difference. You can do so for $24.95 with our 20% discount, Guru20. That's the discount code. You can get that for $20. Brian also has what are called quick notes. Let me put that up there and show that what that looks like to you. So here is what the quick notes look like. He's got some beautiful charts. This document is, I think, 60, 70 pages, somewhere in there, 80 pages, where he actually does kind of what I do a little bit differently. It kind of explicates the content of the exam. There's samples, questions. There's all kinds of goodies in there for you. So that is typically $49.95, and that would include the practice exam. It does include the practice exam. So every step up, is inclusive of whatever you could get in the lower step. That's $49.95 for this document with the practice exam. With our 20% discount, Guru 20, that becomes $40. And by far, the best investment is the whole paid supplement for $65. That's $99.95 with our 20% Guru 20 discount. It brings it down to $80, and that adds the hours of 65 video. Now, what I'll do is in the video description, and I'll pin a comment, I'll put a link to a 65 YouTube video from Brian, so you can kind of see what his style is on the 65. And I'll also put a link to his website in both the video description and a pinned comment. And you can also find those links both to the YouTube channel and TestGeek Exam Prep LLC on the homepage of my YouTube channel. Okay, so I think that's all the housekeeping. So let's get started here. And we're going to be explicating. Usually these explications take us, I don't know, hour and a half, 2 hours. So I'll tell you what I'm going to do. I'm going to set my timer, and I'll just let you know when it's a 30-minute break in this content. So if you want to take a break, you can certainly do so. There's no obligation for you to sit there and try and, make it all the way through. Anytime you want, just hit pause or, come back to it later after you get some coffee, whatever you want to do. Now, you might want to kind of try and get a little longer in terms of your ability to talk about this stuff because your test's going to be a little bit longer. One other thing, these TestGeek exams are designed to have correlation with your results on the actual test. So you might want to pause, attempt it yourself, and get a score and see where you're at. That's not the true of my practice exams. For example, practice exam 1, my practice exams are to give you an opportunity to practice, drill, and rehearse, and allow me to share things, current test topics. It's not designed to be correlated to, it's not like a green light or a, mastery at Kaplan. These TestGeek exams are more like that. Okay, so I'll let you know when there's we've been at it 30 minutes. I'm going to kill my video. I'll pop back up when it's been 30 minutes. All right, so here's our first one. Let me get out my. Which of these portfolio allocations below would you expect to show the least volatility over the next year? Now, I like Brian's exhibit here because very much like the test, there's a lot of stuff that's not meaningful there. What Brian is actually testing you on is standard deviation as a measurement of volatility in terms of what's going on, right, within a set of numbers. And so the answer there is C. One other thing, sometimes when people, I'm explaining the exam, someone will send me, in the comment page, you're welcome to do that, their problem with a particular explication. I'll explain it, but remember, Brian also stands willing, TestGeek himself, to discuss any of his questions with you if you have you find them problematic. And you don't need to buy the supplement to do that. If you say, for example, hey, Brian, Dean was explicating the 65 practice final in question 18. I don't care for Dean's explication. I, find a problem with the question itself. He's more than happy to, do that without you buying the answer key and rationale. All right. So if the Standard & Poor's goes up 5%, what is the most likely result for XYZ with a beta of 1.5? So very much a test issue. Beta is a measurement of a stock or fund's volatility as compared to the market as a whole. And so if this says 1.5%, we're simply going to take, let me get my calculator. Oh, where's my calculator? There it is. We're going to take the 5%. We're going to times it by 1.5, and we get 7.5%. So the answer there is D. If we got like 10%, we would have 2.5% of alpha. Now, alpha is the return in excess of beta. I'm oversimplifying, but that's kind of my job. By the way, Brian and I, unlike test prep providers, are not trying to give you anything other than what we think you need to pass your exam. So the method computing long-term results that takes into the consideration the time value of money is a risk-adjusted return. No, I'm doing process of elimination here. Risk-adjusted return is not part of the time value of money. The real rate of return is what you experience after inflation. After-tax return is what you experience after paying taxes or not paying taxes, if it's a muni bond, for example. And so by process of elimination, I'm going to say that is A, the internal rate of return. And an investor is looking at the past performance of a security over the past 3 years. In year one, it returned 8%. In year two, 15%. In year three, it returned 10%. This compute is to an average rate of return of 11%. This would be probably referred to as the arithmetic mean. Now, I would be prepared to do the arithmetic mean as a calculation. And where I would be prepared to do that is in, where they give you, a series of purchases, dollar cost averaging, and what is the average cost. It looks like I've expanded the exam so big that I got, let me see if I can bring that down a little bit. Yeah, I think we can deal with it. As you can see here, what I've actually done is expand. I'm trying to make it so you can see it. I've been told that on YouTube, put a comment box. Let me know. Are you watching this stuff on YouTube or YouTube on your desktop or YouTube on your mobile? I'm relatively still new in social media, and I've been told the numbers about 50% of people are watching it on mobile. Hence why Dean has expanded this or, got this at 100 and something percent. So if you are watching on your mobile, I hope you can see it. But if you buy the PDF for $20, you'll get a nice, pretty version of this thing. Let's see. Did I do number 4? I did. 5. Which of the following pairs offers the most diversification? A, U.S. equity securities and foreign equity securities. Now, I don't particularly like Brian's version of this question, but I know what he's getting at because, on the test, you're going to get tested on a concept called negative correlation. And very testable that foreign securities, we would hope, by adding that to your portfolio, would add negative correlation. Now, if I'm a modern portfolio theory geek, not geek in the way of Brian, my term of endearment, but what I'm trying to do is add additional diversification. So what that means is, for example, if I already have Pepsi in your portfolio and I buy you Coke, I really haven't accomplished much in the way of diversification. I might be doing that intentionally, but, I would try and buy something that has the kind of the opposite movement, and that's called negative correlation, very testable. So that's what A is about. Now, a follow-up question to foreign equity securities is the easiest way for us as an investment advisor representative to get that done in my customer's portfolio is with an American depository receipt. Now, if we look at these other choices, B, that has positive correlation. If interest rates go up, both muni bonds and treasury bonds are going down. Positive correlation means the same direction. Large cap blue chip stocks, they go typically the same direction. Corporate bonds and convertible bonds. Now, I think this was a good, potential miss here, because if you overthink this thing, you could say, oh, well, maybe because of the conversion feature, but that's not really what the question's going at. It's going at, it trades like a bond until the conversion feature becomes that. So I think D would be a good miss on this. Number 6. According to the efficient market hypothesis, information based on company financials and according to efficient market hypothesis, information based on the company's financials and economics figures is considered to be, and we would consider that to be a strong form of the efficient market hypothesis. Now, a lot of times people get their self in the twist about weak, semi-strong, and strong. And I would just tell you that it doesn't really matter here, because on the test, what we're looking for is for you to come up with the strong form of the efficient market hypothesis in which a customer is willing to accept a market-based return. And as a result of that, you're going to recommend an index fund. That's where that question actually resides as a real test question. In a modern portfolio theory, what is an efficient portfolio? What we're trying to do is create a portfolio, or what portfolios would give me the maximum return with the minimum risk. Now, if you choose to buy the PDF on questions like this, I might recommend you turn it into what I call a poor man's flashcard. The answer here is A. And one thing I might suggest you do is night of or morning of or both before you take the test is just go through and read this and read the question and the right answer. So now I have what I call a poor man's flashcard. In modern portfolio theory, what is the efficient portfolio set? And now I have the efficient market. So that's a good thing to do with this document, the morning of, or night before, or both. What two are most associated with a treasury bond? Well, you should definitely know that you do not have credit risk and direct obligations of the U.S. Treasury. Direct obligations of the U.S. Treasury are T-bills, T-notes, and T-bonds. And you also don't have that in things that have the full faith and credit of the United States government, like Ginnie Mae's. So we don't have any credit risk. So my client's very risk adverse. Maybe we look at that. You certainly don't have liquidity risk. The most liquid market available, liquidity is how quick can you turn something into cash, is the treasury market. There are trillions and trillions and trillions of dollars of treasury bonds trading every day. So you certainly don't have liquidity risk. Now, if you buy a treasury bond, and let's say you get 5% and it matures, and now treasuries pay 2%, that could be a problem. So you do have reinvestment risk, the risk that when your treasury bond matures, you won't be able to get that same rate of return, as well as every 6 months having to reinvest those coupon payments. And you certainly have interest rate risk. So 1 and 4. So the answer here is going to be B. When current interest rates are at 9, you would expect a bond with a nominal yield. You're going to get at least one of these. Hopefully, I don't know if you're coming to the 65 as a fee-based investment advisor representative, because if you're just working for a fee-based firm, there's no broker-dealer affiliation, you're going to take a 65. And if you are coming to this as a 63.65 or a 763.65, in any case, I hope that you haven't forgot your teeter-totter or your seesaw. Now my math modern portfolio theory friends get really upset with the teeter-totter or seesaw. I'll tell you why in just a sec. But if we're looking here and we have a nominal yield of 8%, now remember that's also called the coupon. That's also called the fixed or stated rate of return. And if that's 8%, and this bond has a current interest rates at 9, so what that means, I got this, is that interest rates have gone up. Over here, we call this interest rates. Very testable. We assume that every investment advisor out there knows about the inverse relationship of bond prices and interest rates. So if it had 8 when it was issued, that means the interest rates were about 8 when it was issued. And now interest rates have gone up. That means the bond has gone down. And so we would expect this bond to be trading at a discount. And you're going to have to do that at least once on your exam. Let me just get another arrow here. So this is what this looks like. Maybe that looks familiar. Well, whoop. Maybe that looks familiar from your other exam. Now, my, serious math people who don't like the teeter-totter or seesaw, they don't like it because they say, well, Dean, the seesaw makes that look like a linear relationship, and it's not a linear relationship. A better description of the volatility of a bond to the interest rate movement is called duration. And so duration is just a fancy word for this idea of volatility. Maybe you want to get out of a 3x5 deck or 4x6 deck and, just make some flashcards from definitions like question 1 with standard deviation, maybe a flashcard that says duration. I have a 50 question practice set on what are called analytical tools that you might encounter on your test. Let's clear that up. I think number 10 here is interesting. So a company has 2 outstanding bond issues where they both have a coupon of 8. Bond A will mature in 2 years and bond B will mature in 15 years. If interest rates were to increase 10%, so interest rates went up, so both of these bonds are going down. Which of the following is correct? Both bonds will be selling at a premium. Well, remember that's not the case. I mean, if they have a coupon of 8 in 2 years and 15 years, rates gone up, that's not going to be true. Bond B is selling at a greater premium than bond A. So interest rates have gone increased to 10%. Bond B will be selling at a greater discount to bond A. So what this question is about, as I like it, is which one has the most volatility. And the way you do that is you remember long and low. So in terms of volatility, now be careful, you're on the right side of the question, but you're first going to go to the bond with the longest maturity. Now, in this case, the bond with the longest maturity is, let's see, bond matures in 2 years, 15 years. So we're going to first go to this bond here at 15 years, and we're going to say, okay. And then we're going to look at the coupons. Now, both have a coupon of 8. And so that means that bond B is going to be have more volatility. And so the answer here is C. What we're saying in English is that bond B is going to go down further and quicker based on, again, this concept of volatility based on what we call a duration. So the answer there is bond B. Choice C, bond B, choice C. Don't you love that? Oh. An investor is long 100 shares of XYZ. She fears a near-term correction, but overall she remains bullish because, if she wasn't, we'd sell the stock. Which of the following would allow her to profit? So, on the exam now, 65, I've actually put the options playlist into the, the options lectures into the playlist. I'm not sure how much time on a 65 you want to spend on options or derivatives to get this down. But if you are asking about income, or in this case, profit, that means you're going to sell the option. You're going to sell the option. That alone gives you a 50-50. Now, if on the other hand, you're being asked on the exam, let me get a different color here, about protection, you're going to buy the option. You want to have a choice to do something. So protection, you're going to buy the option. So I'll put contract here, buy the contract. And here we're going to sell the contract. Now, ultimately, what's really important here is this answer set. That answer set is the point. So if you're pretty good at options, maybe you can look at that and say, okay, well, buy a call is a choice to buy the stock, and I don't need a choice to buy the stock because I've already done that. Buy a put would be the choice to sell, but that wouldn't give me a profit because I'd have to pay a premium. Sell a call. There we go. I'm going to do a covered call. I'm going to sell a call on the stock that I own. I'm going to agree to sell the stock I own, and for that, I'll bring in a premium and I can profit. In fact, when I do a covered call, there are three sources of profit. One source of profit is the difference between what I paid for the XYZ and whatever the strike price I write, at what price I agree to sell it. So if I buy it at 50 and agree to sell at 55, one source of profit would be that 5 points. Another source of profit is this question, what I'm going to receive for the premium. And the third source of profit is any dividends. If XYZ pays dividends, that's going to be mine as well. So I say, hey, customer, how would you like to start trading tomorrow with 3 sources of potential profit? Now I'm short 100 shares of XYZ. So I sold stock I don't own. Now, if I don't hedge that, I'm going to have unlimited loss potential. And so now we see a protect. And so when you see the word protect, we know that we're going to either buy a call or buy a put. These are our 4 basic option positions, by the way. This is an explication, not a lecture. But, if you want, I got all kinds of options lectures for you. I've got, hour-long narrative lectures. I've got a little 15-minute carve-outs of the various strategies. You can literally spend hours doing options if you'd like. But anyways, the key here again is once I see protection, I know it's either buy a call or buy a put. And here I'm short the stock. And so this is going to be buying a call. I'm going to establish the choice to buy back the borrowed stock at a set price. And what's really kind of cool about that is if I do that, I've changed the short stock position from unlimited risk to limited risk. That's pretty cool. Pretty cool. Listen, I was just tutoring a couple people on NASA these exams yesterday. There's not a lot of insurance questions. There's more than you would. I don't know if you're comfortable for it. I guess if you're coming to the 65 as an insurance agent, lots of insurance agents take 65 so they can sell and get paid for money management. And hopefully when you come to that, maybe you get the 1 or 2 insurance questions you're entitled to, but don't spend a lot of time on stuff you're comfortable with. And so capital needs analysis is used for planning for an income stream. I joke, I'm not an insurance guy, but if I tell you need life insurance, you really need life insurance. My buddy Jim, I said, Jim, what's going to happen to you? He goes, well, Dean, I don't want to make a bet with an insurance company that I got to die to collect. And I said, well, that's really not, Jim, what the insurance is about. The insurance is about you dying. It's about what happens to your family afterwards. And so, Jim, you need some insurance because the income stream that your family depends on as a senior partner of your law firm is not going to be available any longer. We might need some capital for tax purposes, estate, taxes, stuff like that. And you're not going to be here to complete the investment objective of providing a college education for your daughters. We don't sell you insurance so you can buy more insurance. Now, another test question is to make sure that on the test, the exam, that you don't ever tell me that insurance is a investment. Insurance should be sold as insurance. I joke. Again, what I would do here if you're going to buy the PDF is turn this into a poor man's flashcard. So now I actually have what I'm supposed to know about a capital needs analysis. And then what I might do here is now call this number 1. If you're going to buy the PDF, call it 2. Call this 3. And now, night before or morning of, now I have a good poor man's flashcard. With life insurance, capital needs analysis may be helpful for all the following. 1, planning for an income stream. 2, capital for tax purposes. 3, completion of an investment objective. So if you're going to make poor man's flashcards. Oh, by the way, if you don't want to buy the PDF, I guess you could do that, make that flashcard with your own stack of 3x5 or 4x6 cards. But You know, that's a lot of work. You know, so maybe I should call them, instead of poor man's flashcard, lazy man's flashcards. Which of the following best describes a market maker? So, you know, very important in terms of capacity. So I said, well, listen, when you open an account with my broker dealer, in some transactions, my firm is going to be acting in its broker agency capacity and will be charging a commission. You know, broker dealers get paid by transactions. In other transactions with my broker dealer, we'll be acting in our dealer principal capacity. We'll be charging a markup or a markdown. And some of the securities, the over-the-counter securities you're buying, we do provide liquidity as a market maker. We will always disclose to you if we were a market maker in the security, but we also will disclose on your confirmation in what capacity we acted. And so the answer here is A. You know, you get a handful of questions on, you know, market makers and brokers acting in agency or dealer capacity. So, you know, this is test fodder. An investor is looking to create a diverse portfolio. Now, remember, under modern portfolio theory, theory isn't truth, by the way. Theory is just a way of explaining things. And the more a theory can explain, the better that theory is. And under modern portfolio theory, as I mentioned earlier in the explication of this practice test, we're looking for, as a practitioner, something that provides negative correlation, because we're not really getting much diversification if we buy securities that go the same way or have positive correlation. You know, there's a positive correlation, there's negative correlation. There's no correlation means there's no rhyme or reason about why something is moving a certain way. So would most likely consider which of the following. And so what we're looking at here is this idea of correlation. So we have a stock with a beta of 0.95, correlation of 0.84, beta of 0.90. And then here we go. This is the part we're looking for. You know, we're looking for something that goes the other way. So far, that's the one that has negative correlation. So let's see if the others have any negative correlation. It looks like everything else has the additional. So we're looking to create a diverse portfolio. So in portfolio A, we do indeed have something that goes the opposite way. And so remember, that's negative correlation. So we're going to pick this one. If you're using is Kaplan is your test prep provider. Chuck is the guy who does the Kaplan questions. If you have your student notebook, that's, you know, what you get your class notes from the class. There's a really couple spot on examples of this as a test question. This one's pretty good, but you're definitely getting something like that. And just make sure you read carefully, because sometimes you cannot be reading carefully and they're asking you which one would not, right? Least likely. So be careful. I'm just telling you, be careful on RTFQ, right? Make sure you're reading correctly, least likely versus most likely on the exam. So I call it RTFQ, read the full question. And then also make sure for certain that you're RTFA, reading the full answer set, you know, looking at every answer that's available to you. You're definitely get a question about various forms of ownership, You know, I have a couple of these in practice test one, and, you know, based on what people, you know, have told me they need to be prepared for. So you need to know about C Corps and S Corps and LLC and partnerships. You know, you expect 2-3 questions based on this. So make sure you understand the various forms of business. The biggest ones being test issues, the ones that have flow through, and then the ones about liability. So for example, if you're a general partner, you have unlimited liability, and C Corps don't have a flow through. That's typically it. All right. So among the various forms of business may take, there are the sole proprietorship and the LLC. Two things they have in common. Now, on these multiples, on the actual exam, you're only going to get 3 or 4 of these multiples. And I don't think Brian has gone overboard on these multiples, but test prep vendors certainly do. They have them way more than you're ever going to see. So they're asking sole proprietor in common. Do both have limited liability? Do both have limited liability? No, they don't. A sole proprietor, that's why it's kind of foolish to have a business as a sole proprietor unless it's very simple. Sole proprietorships are very easy to form. That's a neat thing. But, you know, if you have any kind of complexity in the business, maybe that's not going to be such a good idea. So they do not both have limited liability. They both indeed have the flow through, right? If I'm a sole proprietor and, you know, I make money, I pay taxes once on that money. If I have an LLC, the money flows through to me as a member of the LLC. and the money gets taxed once, right? This is coming from Exam Prep, TestGeek Exam Prep LLC. And so that means, TestGeek Exam Prep LLC doesn't pay taxes. That flows through to the members of the LLC. Brian being the managing member, I wouldn't be surprised if he's the sole managing member, not my business, but that money is flowing through and it's getting taxed once. So that is indeed true. Ease of formation. Yeah, both these are pretty easy to form. And an unlimited number of owners. No, but remember, sole proprietorship only has one owner. So, right. So 16 is C. A retiree, what's going on with there it is. A retiree is returning 70 in November 2011. They would be required to take a minimum distribution. So minimum distributions would be April 1st here. I would know on your exam that we do have a type of retirement plan, individual retirement account, where there is no required minimum distribution. By the way, this should be, let me just fix this. I'll bring this up with Brian. It took him forever to change this, but it's now 72. And who knows, maybe Dean grabbed the wrong thing out of my. That should be 72. Well, let me do a better job of that. By the way, that had nothing to do with answering this question. They very rarely. I remember that was like 18 months. They were still testing on the 70. All right, so let's clean that up. An investor is looking to invest $200,000. He first researches individual companies. So I start with the companies. I then see how that company sits within its industry. And then I notice within the industry, some are doing better than others. So this is going to be called bottom up. Now, I think it's more likely on the exam that you're going to see top down, but the answer to this one is bottom up. Top down is where I make a decision about the economy, then the industry, and then I pick a stock. And so I think on the actual exam, A is the more likely scenario. I don't know why in question 19, people turn this into anything other than an aim and shoot point and click question. No, it's December 31st. So, by the way, you don't get many aim and shoot point and click questions. So that make sure you get all you're entitled to on recognition questions like December 31st or 48 hours, whatever the case may be. An investment advisor is meeting with a new prospect. Which of the following performance data could be presented? Now, again, I like the intellectual takeaway of this question, but I don't particularly like Brian's version of it. But who cares? Right? That's what explications are about. It's D. But what we're trying to say here is you can't cherry pick. You can't show them just your best account. You can't, if you're showing them your hypothetical portfolio, take the mulligan on the worst one, but also take the bad one. You have to show them your entire universe of selections. So I don't particularly care for the phraseology, but I do certainly like the takeaway that you have to provide the entire universe or all of your past recommendations. Okay, so let's boom. That is my timer telling me we've been at it 30 minutes. So if you'd like to take a break, now would be the time to do so. And, if you're going to chunk it in 30 minutes, I don't know if you're going to chunk it in 30 minutes or how you want to chunk it. But if you're chunking, this is a 30-minute chunk. I'm going to continue to march on with the explication. And most of these come in at about 90 minutes. We'll see how we do on this one. Maybe we'll be a little over, a little under, who knows. But I'm going to continue to march. So enjoy your break and I'll see you in a minute. Remember, if you're trying to use this as a correlation, a practice diagnostic exam, just hit the stop button. Maybe too late now because you've seen some answers, but you stop, try your answer, and then hit play again and see how you did. Okay, so here we are, 21. An investment advisor representative works for a federally covered investment advisor. So I'm a 65 who works for a federally covered investment advisor. The investment advisor's main office is in state A. Now, I recommend that when you get this, you just put your state in there, get rid of some of those grammar problems, right? So I'm coming to you from Las Vegas, Nevada. So I'm going to say my investment advisor's main office is in Nevada. The investment advisor rep travels to state B, California. Under the Uniform Securities Act, which of the following is true? The investment advisor need not be registered in state B. Yeah, as long as I don't have a place of business in the state. So as long as I don't have a place of business in California, I, as a federally covered, working for a federally covered advisor, can go to California. I'm only going to need to be registered in California if I have a place of business in California. That is very testable, by the way. So we're not talking, one thing you want to work on is your skill at distinguishing whether you're being asked about a broker dealer or an investment advisor. And then if you're being asked about an investment advisor, the next thing you're looking is, what kind of investment advisor is it? I'll link it in the video, but I have a lecture called Who's Your Daddy? You're either going to belong to the states or the SEC. So if you're federally covered, that means you belong to the SEC. So need not be registered in state B. Need to be registered in state A since the IA is federally covered. Well, you're taking a NASA exam. You are taking a NASA exam, which the following is true. AI need not be since the AI is federally covered. 3, the investment advisor representative needs to be registered in state B. 4, the investment advisor needs to be registered in state A. So here we only need to be registered in state B. So let's see here, the answer to 21. I need to be registered in state B, and I need to be registered in my home state, which is Roman numeral 4. So B, I like that. That's a pretty good example of registration, right? So now if I open a place of business in California, then I'm gonna have to register in California. If an investment advisor is registered in 5 states, so that means you're not federally covered. That means you're not federally covered. Because remember, you're either going to be one or the other. You're never both. Who's your daddy, right? So the only way you can have more than one daddy is if you are, a state investment advisor. So you're registered in 5 states. You have a principal office in state B. So that's your home office, your principal office, and 3 other states. The investment advisor must meet the capital standards of, you got to meet the capital standards of your home state. So, it'd be a mess if you had to meet 5 different standards. So I can tell these 4 other states I've met the standard, the capital standard of state B. Now, remember, ladies and gentlemen, on the template, the Uniform Securities Act isn't, state law. It's a template you're being tested on. And on that template, remember, there's going to be 2 net worth or capital requirements. It's going to be 10 grand or 35 grand, depending on, what kind of control of the assets you have. So certainly make sure you review that. 3, if a federally covered registered advisor, so again, you really want to get comfortable reading federally registered investment advisor, has its principal office in state A, remember what that, make sure you know what that means too in terms of assets under management, 100 million or more, can't fall below 90, all that stuff that, you get tested on. Has a principal office in state A and has offices in 3 other states, and a client of an investment advisor rep is registered, who is registered in state A, the home, that's our home state. My client, so again, be careful who's moving here. The client moved to state from state A, moves to a state in which I, investment advisor representative, is me, the 65, is not registered. And again, that's the neat thing about being federally covered. I don't have to register. The only time I'm going to have to register in the new state is if I have a place of business in that state, if I have a place of business in the state, or I, fall and run out of the de minimis. So the answer there is A. The FDA has changed their rule regarding testing of a new drug from 1 year to 2 years. That's regulatory risk. Regulatory risk, right? I would know what legislative risk, that's any investment with tax advantages. Like, Senator Roth is no longer here to protect a Roth IRA. What Congress giveth, Congress can taketh away. The dividend exclusion ratio used to be 70%. Now it's 50%. So that legislative risk, I'd be prepared for that on the test. The answer to this is C as in Charlie. But on your test, the answer could be B as in boy for any kind of a tax advantage investment. And then I would definitely worry about D as a test issue. And on the test, make sure you know that, typically fixed income investment vehicles are not going to do very well. They do indeed have inflation risk. And the thing that we have, the arrow in our quiver that would do well, is common stocks would do better in an inflationary environment than fixed income, and then have an understanding of TIPS, Treasury inflation protected securities, that are adjusted to the principal value by, whatever that CPI rate is. Well, here we go again with the most important answer set. It says it's a covered call. And remember, covered call is used to generate additional income. And so, that's what we're going to do. When does an SEC register corporation? AK is for a material current event. A material current event. So, for example, Microsoft has acquired Activision. Disney has acquired Fox. That's going to require an AK. A change in top management. We have a new CEO. A change in our accounting firm. Absolutely. Now, you can get this right with the Sesame Street trick. The subsidiary relocation is not a material event. Kaplan Financial has had a subsidiary of Graham Holdings is in La Crosse, Wisconsin. Moving to Florida wouldn't trigger an AK. Now, the home office moves, that's an AK. For example, recently, Tesla has relocated from Fremont, California to Austin, Texas. Recently, Charles Schwab has relocated from San Francisco to Westlake, Texas. That would trigger an AK because that's not the subsidiary that's moving, it's the corporate headquarters. Mary and Joe, age 55 and retired, have a small inheritance that pays their living expenses. However, they do not have enough for retirement. So that means we're going to need some price appreciation, it looks like. Which of the following should the agent recommend? Investments in bonds. Yeah, given this answer set, I'm certainly not going to do a money market. I think what I would go for here is some good total return. Maybe get some income stream from the bonds, and maybe some upside on the stock for some good total return. So I think best asset allocation there is going to be the B, some bonds and equity. A federally covered advisor. Again, we want to be very careful on these federally covered advisors. It has its home office in state A. It solicits 5 customers in state B and it holds a seminar in state C. Which of the following is true? Again, we're getting at this idea of why so many investment advisory firms would prefer to be federally covered, because if you're federally covered, then you don't have to comply with all the stuff that state people do. I have all kinds of people coming through 65 class who have been hired by investment advisors to get them to the 100 million so they can become federally covered. An advisor is considering purchasing a thinly traded stock for his client's accounts and his own account as well. So, you're not supposed to trade ahead of your customers. That's called front running, and that's a big no-no to trade ahead of customers. So the customers always come first. Violation of that would be called front running. The CEO of XYZ is a trustee for his company's employee pension plan. He gives you instructions, you, the investment advisor representative. By the way, I would suggest every time it says IAR, using me, who manages the plan, to loan the company several $1,000s to pay off a company bad debt. So, the CEO now has an adverse interest. Adverse interest, you're taking a legal test. That just means an interest that is counter to that of the pension plan. You, as an investment advisor representative, representing your firm, which is also a fiduciary to the customer, and the customer here is not the CEO and it's not XYZ. It's the pension plan that is your customer in this example. And so the answer here is C. Characteristic of an S&P, there are going to be at least a couple questions about index funds. I gave you one about efficient market. I say, hey, I don't think there's any added value to, active management of a mutual fund. I realize that most people can't outperform the market. I'm willing to accept being market-based return. Again, I recommend an index fund. And since it's passively managed, it typically has a lower management fee. Outperforms markets, that's a really bad miss. It has a high dividend payout ratio. It has moderate turnover. No, it has very low turnover. So given that answer set, the answer is C. An advantage of investing in a mutual fund of foreign stocks is you should definitely know if the foreign company is collecting or doing business in the foreign currency. You certainly have foreign currency risk. That's a major, misrepresentation. Whether it's intentional or ignorance or maliciousness, it's still a misrepresentation. Yeah, I mean, if I was going to invest, for example, in Mexico, I would probably want to do that through a Mexican mutual fund where there's a guy who speaks Espanol, knows the locals, and will pick those foreign stocks for me, whether it's Telefonos to Mexico or Grupo de Modelo, whatever the case may be. Elimination of the market risk through diversification. No, very testable know that market risk prevails despite diversification efforts. So you should definitely, no diversification doesn't help you on that front. Reduction of the foreign tax liability. No, I mean, the company's still going to have to, pay the taxes to the Republic of Mexico. Surrendering our whole life policy is appropriate for which of the following? And all the following except, I don't like the phraseology here. I think Brian's getting at an exchange. And so when you do this, you're not doing it to get cash. You're doing to do what's called a 1035 exchange. I think that's what he's getting at on that one. So I'm going to go for A. I can also choose A using what I call the Sesame Street trick. One of these things is not like the other. If a client takes out a loan from his whole life policy and does not pay it back, this is very, very much something you should be aware of on the test. The insurance company can do which of the following? And, I think this is a great, again, poor man's flashcard. So if you're not going to buy the PDF, then you can do it. That wouldn't be the poor man's flashcard. But let me tell you again, on questions like that, they're just spot on. By the way, the other thing you're trying to do in these explications, there's two of them in our 65 playlist. There's Dean's version, and then there's now the one we're doing, which is Brian's version. And one thing I would recommend with that, and then, I told you Kaplan, the guy who does Kaplan, was a guy named Chuck. And for example, if, Dean has a question like it in practice test 1, Brian has a question like it in his practice, we're calling this practice test 2, and then Chuck has it in Kaplan. I don't know who the STC guys is or past perfect guys, but, you're looking for confirmation. If you keep seeing the thing over and over and over again, it's kind of a hint of something you need to be prepared to encounter on your actual exam. And, angels weep for you if you're not. I don't know about you, but when I take a test, I always feel better when I get to the question I know the right answer to. Now, I would admit that 65 is difficult in this regard. I had somebody the other day I was debriefing, and she said that she actually understood the question and was looking for the answer, but she didn't, recognize the answer set. So it's the 65. I consider like to be a baby 7. It's tough. It's a tough exam. So. Which investments is most tax efficient? Again, we know you're going to get this question about an index fund from 2 or 3 different directions, whether it's the efficient market hypothesis, whether it's based on having a lower expense structure, or in this case, the capital gains tax is a transaction-based tax. The easiest way not to pay it is not to transact. And we said that index funds are passively managed. So, you would expect not to have as many capital gains distributions from an index fund as you would from another type of a fund. What did Dean do there? Almost blew it. Brothers Jim and Joe inherited $10,000 in mutual funds. Jim redeemed the shares several times over the next several years and placed the money in a savings account, leaving him a balance of $11,000. Joe did not redeem any shares and has a balance of $50,000. Well, there's nothing in this question. Again, there's a lot of ways to approach this. I might approach this by process of elimination. There's nothing in there about interest rates. There's nothing in the question about inflation. There's nothing in this question about turning the money back into cash and how difficult it might be. So that's called opportunity cost. And it's called opportunity cost. An investment advisor, notice investment advisor representative notices. That's the other thing you want to be, again, practice is this is about a natural person, a living, breathing human being taking a 65. This isn't about your firm. It's about you. Investment advisor representative notices while compiling a financial report for the client that there may be a significant tax consequence in the future. Now, I don't really, like Brian's version of this, but this is very testable. What I mean is his answer sets, but don't get nothing but love. My brother from another mother. But I do like the intellectual takeaway here that we're supposed to know 65 so we don't give tax or legal advice. that we would refer you to an accountant, a tax accountant, or, if it's legal, an attorney. It used to drive me nuts as a practitioner when my very wealthy customers would try and get free advice from me, who is not an accountant and not an attorney. And so, listen, I don't know why they don't like paying those people. By the way, they sometimes complain about how much the people I referred to them charge. And I go, well, you charge us what's, what's necessary. I don't know why you're being frugal about it. You just need to spend the money. It's money well spent. Trust me, money well spent. Which of the following would be the best way to file a tax return? I think the best way here would be head of household. A 68-year, because of the two children, right? That's why. A 68-year-old woman is seeking preservation of capital with a secondary objective of income. Which of the following would be most appropriate? Boy, this is a tough one. I'm not quite sure what I would go with here. It looks like I'm certainly not going the municipal bond because there's nothing that tells me anything about taxes in the question. I'm going to go for the money market. I would prefer to have a better answer set than that, but that's going to be liquid. It's going to have a stable NAV at $1. It's not going to fluctuate in terms of price, and you can get the money anytime you'd like. So I'm going to go for B. According to modern portfolio theory, investing in multiple asset classes attempts to reduce which of the following? Remember, we're trying to maximize this thing. So you should know that modern portfolio theory doesn't have anything really to do with liquidity risk or credit risk or interest rate risk. Modern portfolio theory is about trying to maximize return while minimizing risk. And remember, that's called market risk or systematic risk, whatever floats your boat. If I miss this, maybe I just overthink it. Those other things are not associated with that. Liquidity risk, don't recommend a partnership, for example. Credit risk is default risk. And interest rate risk has nothing to do with modern portfolio. That's interest rates go up and the bond goes down. According to the Uniform Securities Act, which of the following is considered a sale, a transaction? I like this one. You should definitely know that if you pledge securities as collateral for loan and I'm your lender, I can sell the securities without running afoul of the Uniform Securities Act. You should definitely know that a bona fide loan of stock, when liquidated to meet the terms of the loan, is not a sale. An offer accepted becomes a sale. And what we're trying to test you on here, Brian, is that's not a transaction or sale subject to the jurisdiction of the Uniform Securities Act. So the answer there is C. That's a very good example of something you might encounter. Here's Brian kind of being a jerk, I think. He's trying to bait you on this thing. A husband and wife are 55 and 57 respectively. The husband plans to retire at 62 and the wife at 65, and both are healthy. Be careful. Brian didn't ask you about the time horizon for them. He asked about the time horizon for the portfolio we're going to create for them, right? This isn't about the time horizon of the husband or the wife. It's about the time horizon for the portfolio. How long is this portfolio going to have to take care of this husband and wife? Going to have to take care of that husband and wife for 20 plus years would be, I think, the most appropriate answer. An investment advisor, a representative, hires a solicitor to recruit clients. According to the Investment Advisor Act of 1940, what records would the investment advisor be required to keep? Right? So I'm a third-party solicitor for an investment advisor. That's typically a broker dealer that's been hired by an investment advisory firm. Go find them clients. That's what that is in English. And now it's asking me who needs to keep the records. I did a lot of this before I retired. I was a third-party solicitor for investment advisors. And, what I have to make sure the client understands is a disclosure that tells them about Gamma Global Investments, the broker dealer that's been hired as a third party to solicit on behalf of the investment advisor, Carlisle. Right? Those are the two disclosures: a brochure that tells you about the investment advisory firm, Form ADV Part 2, or a brochure, and a brochure that tells you about the third-party solicitor, in this case, the broker-dealer. And then what Carlisle is going to want is acknowledgement that both those disclosures were given and signed by the client. 44. What information do you need to determine the future cash flow from a bond? The future cash flow from a bond. So you definitely need to know cash flow has to do with the income stream. And so I'm going to need to know the number of payments to do any kind of a discounted cash flow, whether it's dividend discount cash flow from a bond, or whether it's dividend discount from a stock. I'm going to need to know the number of the payments that we're going to receive to determine that. The amount of the interest payments, well, you need the amount, but more importantly, you also need the, that this is kind of the same thing there. So given this answer set, it looks like A is going to be our best answer. According to the Uniform Securities Act, it's very important to know you're taking a legal test. And this is no different in the Uniform Securities Act than just legal in general. Who's not considered a person? Minors are not persons. They can't be held legally accountable. Persons now deceased can't be held accountable. People have been legally declared legally incompetent cannot be held accountable. So the answer is C. I think that's a good poor man's flashcard. So again, if you buy the PDF, I'd also give rid of this. This is Brian just trying to get you distracted with the prodigy worth millions. That doesn't have anything to do with answering the question. Maybe I make this age 16. I could just, if I want, I could just, annotate this and say minors. And there are a lot of ways to proceed. An agent of the broker-dealer whose home office is in state A. Now, again, be very careful. This is a broker-dealer. This isn't an investment advisory firm. It's a broker-dealer. Broker-dealers are always going to be registered with the SEC, with FINRA, and at least one state, because I have a home office. So no doubt this broker-dealer is going to be registered in state A. I have a client in state B. By the way, there is no de minimis for broker-dealers. And so if I have a client in state B, a retail customer, I'm going to have to be registered in state B. The only exception to that would be I have no office in state B, and that client is an institutional investor. There's nothing here that says, I have some very bright men and women who struggle on 65, and I think they start overthinking this thing. If it just says client, you don't bring extra stuff into the question. So I have a client in state B. I need to have the broker-dealer registered state B. By the way, I, as an agent or associated person, need to be registered in state B as well. The client who moved to state B or is in state B has mail forwarded to state C. Well, how am I supposed to know that? That has nothing to do with me. So I'm going to say I'm going to get registered in state A. Shouldn't be struggling with the home office of a broker-dealer, whatever state it is, it has to register. And you shouldn't be struggling that a broker-dealer that has a customer in a particular state is going to have to be registered in that state. So shouldn't be struggling with that. A equity index annuity, definitely testable. I can't imagine high probability you're not going to get at least one question here. And so here a customer has purchased an index-based annuity with a minimum rate of 2. So the minimum I'm getting is 2. The key thing, ladies and gentlemen, is make sure you understand it does there's no negative reset ever. So people have told me they encounter this idea of this equity index annuity and they tell you the market goes down, then you need to know reset is not going to be, in this case, it would be a minimum of 2. So make sure you make a note to yourself, mental note. I'll just put it here in the annotation, the explication. There's never a negative reset. I have my version of this in practice test 1. Anyways, so it says the annuity has 80% participation. So now they're saying that we'll give you 80% of whatever, the index does. So the index rises 20%. So I just like to, pretend I'm looking at $100,000 just to make it easy. So that means I'm going to go up 20%. Grab my calculator. And so if but remember, I don't get the entire 20%. I get 80% of the 20%. So I'm going to take, I'm just making up numbers, but if I make up numbers and make them easy. So I'm making up 20 grand. I don't have to do that. I could just take 80% of 20, but I'm going to times that by 80 because I just do better when I'm looking at numbers. I get 16% is what I get, 16,000. So I'm going to say the answer to 47, I'm going to say is D. And then remember the minimum I'm going to get is going to be 2. So if this went down, I'd have 102. So just make sure you got that. Boom. An investment advisor is a trustee of a trust. So the investment advisor, the firm, is a trustee of a trust with 2 or more beneficiaries. According to the prudent investor rule, which of the following is true? The trustee should take into consideration the beneficiaries and act impartially. 48, the trustee should not take into consideration the beneficiaries and act according to his investment policy. The trustee should pro rata the assets and manage each according to the future needs. I think given that answer set, I think our best answer here is going to be, I'm kind of stuck between A and B. I'm going to go for should not take into consideration the beneficiaries and act according to his investment. I don't like that. I like B, but it says his investment policy. That's what I don't like. I think given that answer set, I'm going to go for A. No, that's C is not true. D is not true. Which of these efficient market hypotheses? Cannot be based on historical data. So whether you're doing a fundamental analysis or technical analysis, you're looking at historical data, and they're saying historical data doesn't work, and so that's going to be the strong form. By the way, that's people, again, I told you, get hung up on this. The one they're looking for on the test is strong, so that should be kind of your default kind of position. What do an S corp and a general partnership have in common? So the company enjoys not paying tax. Well, no, they're going to. The companies, there's going to be a flow through of the profits and the losses. General partners do not have ease of transfer ownership. General partners do not have limited liability, ease of formation. Now, given this answer set, our best answer is A, that the S corp or the partnership are not paying tax, the owners are. So that's going to flow through the owners in terms of what's called a K1. The profit or losses are going to flow through. The application for registration under the Investment Company Act of 1940 is filed with whom? I would definitely know what is a federally covered security. A federally covered security, one of them is a mutual fund. And so if it's a federally covered security, like a mutual fund, you're not going to register with the state, you're going to register with the SEC. The internal rate of return calculation dictates that the interest earned on a portfolio is reinvested at the internal rate of return. No, that's a calculation that takes that into account. That's the math already done. The inflation rate, Treasury rate, this is an easy one to miss. It's whatever the required return is, right? And so we can, run that math several different ways with different required returns. A lot of my math friends use the Treasury note, but you can use whatever you'd like as a required rate of return to do the math, right? So that's a D. Which of the following factors is not relevant in determining whether someone is an investment advisor? Yeah, you remember the ABC test? Do you give investment advice? Do you tell people you're in the business of giving investment advice, and do you want a fee? So the answer here is A. The frequency has nothing to do with it. Well, there we go. There's our another 30 minutes. So we're now at an hour. So if you'd like to take a break, you can certainly do so. You can pause, come back, watch it later, whatever you'd like to do. I'm going to continue to march because I want to get this uploaded on Tuesday. We upload on Tuesdays, 3 p.m. Las Vegas time. And so I want to make sure I get this done. So, I don't know if I should have committed to weekly uploads because, the channel is nonprofit. I sometimes feel like I'm doing a lot of work for free. Anyways, I'll stop whining. Let me get back to work. You could take a break. I'm going to continue to march. Okay, so a diverse portfolio would hold tangible assets to address which. I like this, by the way. I like this question. We need to have something in the portfolio that addresses inflation. And tangible assets do that. The other thing that would do that is a test question, precious metals. Another thing that would, perhaps help us. I won't say beat it, but help us would be a tip. And so very much a test question. Again, I've warned you about turning what should be aim and shoot point and click questions into judgment questions that aren't there. So again, if you're going to buy the PDF and you're going to print out, because you get the PDF, you can print it once to make poor man's flashcards and print it again to do a practice file. I was just talking to somebody who did buy the PDF, and I had recommended that they put it away and do it as a diagnostic. You're probably going to do much better than you would plan if you watch me go through this already. But in his case, this is before the explication, so he didn't have this to watch. That being said, I said, since you're going to get this from Brian and you haven't watched the explication, maybe do it as a practice final, diagnostic, and see what correlation and see where you're at, and then go back and watch the explication or turn into poor man's flashcards, whatever you want to do with it, So who says dead trees still aren't, have any use in today's environment? The investment advisor realizes Monday they've fallen below that net worth requirement of 10 or 35,000. They contract the administrator Tuesday. When do they have to take care of this? You have 24 hours to do that. So you contacted them Wednesday. So the answer is going to be 1 business day is what you have. And so it's going to be Wednesday. You also have to tell them, what you're going to do to fix it, whatever you plan to get back over the 10 or 35. Individual employed by a federally covered advisor, that's you, would be required, well, maybe not you, maybe you're state covered, but you'd be required to become registered as an investment advisor in the state if, and again, I love Brian's answer here, very much like the test. There's a lot of stuff. The only thing that's meaningful here is, do I have a place of business or not? So the only clients receiving the advice are large pension plans organized for employees of municipalities located in the state where the individual maintains an office. So if I'm a 65 for a federally covered investment advisor, this first part has nothing to do with answering this question. I have an office in the state. I do not have an office in the state. I do not have an office in the state. The only function performed is preparing the layout of research report prepared by the firm. It has nothing to do with it. So the answer here is A, very testable. If I'm a 65 for a federally covered advisor, I do not have to register in some other state other than the home state of my investment advisory firm unless I have a place of business. And, ladies and gentlemen, the test providers torment you on what is a place of business. On the test, it's very simple. It's not simple in terms of grammar, Brian. That's not, I don't think, a simple question. But once you can figure out what you're being asked, once you can figure out what Brian is asking you here, then it becomes a relatively simple question. 58. Under the Uniform Securities Act, when an investment advisor representative acting in the capacity of a trustee of a family trust executes a transaction. So I'm a 65, I'm the trustee of our family trust, and I do a transaction. That's what this question is about. Well, that's non-exempt. That is a non-exempt transactions, but not other trustees. So this is, you're not a fiduciary here. What Brian is trying to convince you is that you are a fiduciary like the trustee in a bankruptcy case, which would be an exempt transaction. There's nothing here that makes this an exempt transaction. So the answer is C. That one's a tough one. But remember, there's 2 types of trustees. There's trustees in bankruptcies appointed by a judge, and those transactions of that fiduciary are indeed exempt. That is not the type of trustee we're talking about in this question. Sharon Smith is an agent of a broker-dealer. So if this is you, that means you have a 6, you have a 7, and you're registered, you're representing a broker-dealer. The broker-dealer is registered in all 50 states. Now, that doesn't necessarily mean that Sharon is. So Sharon's broker-dealer is registered in those 50 states. Sharon receives an unsolicited order from a bank located in the state X, a state in which she has no place of business. It doesn't matter. No place of business about 65s, not people who work for broker-dealers. And so the answer to 59 is the unsolicited transaction is exempt, but the question isn't about the transactions, about Sharon. And if you're working at a broker-dealer, I know lots of people have to get licensed in all 50 states because they're answering phones at customer service for broker-dealers that have customers in all 50 states. And so Sharon has to be licensed in any state in which he's interacting with a retail customer. So the answer 59 is B. Which of the following best depict or show time-weighted return, time weighted return. That's going to be A. So time rated is used for people where we have money coming in and out, right? The volatility of the securities holdings here. So, time weighted is the volatility of the securities holdings. '61, an investment advisor is registered in 10 states regarding financial requirements. So we're talking about the 10 grand again, or the 35 grand. The investment advisor must meet those of, remember which state we said it is? The state in which their principal office. That's a great aim and shoot point and click question, right? We said if you're going to make poor man's flashcards, there's some of these that. Now, again, be careful when you're asked about a broker dealer, because broker dealers are a different answer than this. We're talking about an investment advisory firm. So make sure you're paying attention to what you're being asked about. A federally covered advisory has offices in 10 Midwestern states. Regarding record keeping requirements, the IA must meet those. Well, federally covered again. So, boy, you really got to read closely. Let me clean up my slide here. And boom, we got to really pay attention to that. So federally covered it again. So now this 10 Midwestern states has nothing to do with answering the question. It's the SEC. Who's your daddy, right? 63, with regard to the North American Security Administrators Association statement of policy on dishonest and unethical business practices of broker dealers and agents, prescribed actions. I like this. So prescribed is, like the test, it's like learning a foreign language, right? So prescribed means prohibited transactions. That's what that word means, prohibited. And I think, Brian's trying to, get you comfortable with this language. Prohibited would include accepting an order from a third party after you've got the trading authorization. Well, that sounds like that's okay. Right? Forwarding a written complaint from the customer to the appropriate supervisory person. That's what you're supposed to do. Remember, this says what's not supposed to do. That's what that word means. Offer to repurchase a security. Big no-no. You're not supposed to hold investors harmless. Right? Not supposed to hold investor harmless. Borrowing from a customer, never as an investment advisor representative. So the answer is 3 and 4. A savings loan organized in state A and authorized to do state and B has an offering to be excluded as state B. In order for the individual, that's the natural person, the living, breathing human being, to sell the offering and be excluded from the definition in state B, what we need to be is an employee not receiving any compensation. So it would have to be implied by the broker dealer. Let's see, state B has an offering. Would have to, there we go, have to be employed. So if you're, and then not receiving compensation, again, there's nothing here about compensation. So I'm going to go for A. Let's see what, again, on 65, you got to really read RTFA, read the full answer set. I like A. I don't see anything why they need to be a broker dealer. So I'm going to get rid of B. Again, I don't know. They're not a broker dealer. C, could not sell without being an agent. No, as long as there's no compensation, that might work. 65, again, federally covered investment advisor. You split your time between an office in state A, and now you have a place of business in state B. So the rest of this has nothing to do with answering the question. It doesn't matter, but this 1, 2, 3, 4 have nothing to do with answering this question. If I have an office in state A and I have an office in state B as a 65 for a federally covered investment advisor, I'm going to have to register in state A and state D. I like that. That's, Brian's had this 3 or 4 times for you. That's a hint that, got to have a handle on that. Following the advice of their portfolio manager, a hedge fund executes most of its securities transactions through a registered full service broker dealer. In order to compensate for the commissions charged, the BD allows the employees of the hedge fund to use furniture and facility at a discounted rate. So soft dollar compensation is paid by the broker dealer to investment advisors. So the challenge here is that the hedge fund the fund itself is not typically registered, but the people managing the hedge fund are typically federally covered investment advisors. So you can imagine, for example, Bill Ackman, Pershing Square is his hedge fund, and whoever he's doing business with, I don't know who it is, let's say it's Goldman Sachs, they love him. You know, if I'm an investment advisor and I'm doing business with a particular broker dealer, you know, I used to use as my broker dealer for my investment advisory firm, I use Schwab. I'm not a hedge fund, but same general idea. Gamma Global Investment Advisors is using Schwab, the broker dealer, for execution and custody, you know, or TD Ameritrade, whoever this may be. So we're asking, what can TD Ameritrade as a broker dealer compensate or pay for on behalf of the investment advisor? And what they can't pay for, very testable, the broker dealer cannot pay for. So again, whether it's an investment advisor that is a hedge fund or any other investment advisor, is furniture, rent, and travel. And so here we got furniture, and then we got discounted rent. And so this is going to be a problem. So this is a problem. We're looking for, nope. A says it's okay. B says it's okay. And C is the answer. It is not okay. Now, for a broker dealer to pay soft dollars, compensate the investment advisor, it's got to be for the customer related activities that help the customer, not help the firm. 67. An investment advisor rep, that's you, 65, is assuring clients of a steady rate of return. Ooh, how can you do that? You should definitely know that's prohibited. So now you have a 50-50. You know, why is it prohibited? It sounds like to me, A is a better answer than B, because, you know, the customer is going to think steady rate of return means this thing is never going down and their capital is at risk. And so the answer is A. What is the requirement of a joint tenants with rights or survivorship account? Oh boy, I kind of disagree. I'm not sure what Brian's getting at on this one. The account owners must be spouses. The account owners non-spouse account owners must not be related. I don't like this at all. So I'm going to go. Typically I see this with husbands and wife, but it doesn't necessarily have to be a husband and wife. This could be, you know, for example, a mom is retired. I take care of mom, and I'm on her account as rights of survivorship. But you know, the test question is either party can act. There's no fractional interest, and the decedent share goes to the surviving parties. And not one of my favorite Brian questions. 69, included in the Uniform Securities Act definition of an exempt transaction would be any transaction by all the following except. Again, I like this. What we're getting to here again is this officer of the court idea, right? A sheriff who is carrying out a legal or lawful order of a court to seize a particular asset, seizes that asset. The asset is a security, does not need to worry about the Uniform Securities Act. That would again be an exempt transaction. A guardian appointed by the court, and the guardian is buying and selling securities. That guardian need not worry about running afoul of the Uniform Securities Act. A transaction by a trustee in bankruptcy, where the trustee is appointed by the judge to liquidate securities if need be, need not worry about running afoul of the Uniform Securities Act. This is the second time Brian's tried to trick you about the difference between a trustee that is appointed by the court in a bankruptcy versus a trustee in a trust account. Those are different things. I like this as a poor man's flashcard again. And when you're making those, you don't want to study the except stuff. You want to study the stuff that is not, you know, the stuff you need to know. And so these are exempt transactions, and that's what the takeaway should be. And again, maybe I decide I'm going to label this, you know, as what I need to know for the test. And what I need to know for the test is this is 1, this is 2, and this is 3. So now I have a nice thing to read the night of or morning of what I'm supposed to know. So that, boom. A broker-dealer operating on the premises of the bank would have to make certain disclosures in advertisements and all the following except. I think that C and D, I should know. I'm definitely going to have to make that. So now I say, 30 seconds or less. No, there's a scrolling TV, you know, radio spot. I haven't anybody ever tell me they've seen this. So I'm not sure why Brian has this as a question. Maybe he has some reason for putting it there. It just wants to show you things you should hear. A broker dealer accepts them. So everyone, which of the following statements regarding email communications are correct? Over and over and over again, administrator has said they make no distinction about, email versus regular, snail mail. The rules are the rules are the rules. And so the answer to 71 is going to be 1. They're sometimes referred to as electronic communication. That's true. Customer complaints received by email. No, if it's in written form, text, a text message, an email. 2 is certainly not true. I think your common sense would tell you that's not true, because that would lead to a word on what rep says, hey, email it to me. No. So that's not true. Once received and reviewed, they may be discarded. That doesn't sound like a prudent thing to do. They must be retained in the same fashion as any other record. Yep, there we go. So it's going to be, the answer to 71 is going to be B. 1 and 4. Present value is a computation that's frequently used to determine the amount of deposit needed now to meet a future need. That's called the future value of money, such as college education. If the investor uses an expected return of 8, but the actual return is 10, boy, we'd be happy, right? We're going to end up with more money than we thought. Woohoo. I would expect to see this as either a higher than anticipated question or less. So we assume 8, we get 6, and the answer is B. So either version of this, I would expect to do something along these lines. Again, there's another question about the time value of money. The time value of money. Stop orders. A customer enters an order as follows: sell stop at 45, limit 45.50. So what I'm telling my broker is if the stock trades at or through 45, I want to sell it, but only if I can get 45.50 or more. The following trades then occur. So we're looking for 2 things here. We're looking for a trade at or through 45. And then we're looking for whether we're going to accept the report or the trade that we're looking at next. It's got to be a trade. If we see trade at or through, 2 separate events, by the way. It says 2 contingency or qualifiers. Now, if you need to get back up to speed on orders, I don't think I have types of orders in the playlist for 65, but if you need to, there's about an hour and a half lecture there that can walk you back through the various types of orders. Again, it's hard for me to decide whether to put stuff in the 65 play lecture because it's kind of like a baby 7. And there's a lot of onesies, twosies, and threesies like this that, I'm not so sure how much hours you want to devote to it, but it's there. But it's, if you tell me you missed the mark on 65 because of sell stops, I'm going to say, I don't know. Anyways, the sell stop is below the market. So sell stops, where they become market orders or limit orders, are placed below the market. So 47, nothing happens. 46, nothing happens. 45.12, nothing happens. We're looking for a trade at or through 45. So there's no way to go 497 without going through 45. So now we have a live limit order, not a live market order, limit order, 45.50. So they won't accept that. 45.97. Yeah, that looks like they'll accept that because that's 45.50 or more. So the client most likely received, it looks like the client most likely received in question 73, A, 45.97. Now be careful on this on the exam. When did the order become live? The order became live at D. So if they said, where does it become a live limit order? That would have been D. That wasn't the question. They asked, where was the execution most likely received? So be careful again what you're being asked. The answer is A. Over the past 5 years, an investor's portfolio has shown returns of 6%, 4%, 11%, 10%, 4%. Which of the following statements is true? Now, I'm kind of lazy. So what I like to do is go to the first one that I can do pretty easily. And the one that's easiest for me is the range. That's the difference from the low number, 4%, to the high number, which is in this case, 11%. And so the range is 7%. Now, Dean being the lazy guy I am, I now can get rid of anything that doesn't have a 4 in it. And now I know that 3 is true because I only have one answer set left. Both answer sets left have 3 in it. So now all I got to do is decide whether I'm going to put 1 in it or 2 in it. So the median return is the middle number in the sequence, but I'll just add the numbers up because that's easy for me to do. So I'm going to take 6 plus 4 plus 11 plus 10 plus 4. And I get that 35, and I'm going to divide that by, let's see, 1, 2, 3, 4. I'm going to divide that by 5. And I get the mean return is 7. So now Dean can answer if I'm taking 1, boom, 1, 2, 3, 4. I have this in both my explication that's in the 65 playlist, analytical tools. I have it as a practice question. If you're a Kaplan student, I don't know about other Kaplan has some good versions of this. I'd be prepared for a question like that. A fiduciary of an ERISA plan. ERISA stands for every ridiculous idea since Adam. No, I'm joking. It stands for the Employee Retirement Income Securities Act. So that's what that is about. That's about the Employee Retirement Income Security Act. A fiduciary of an ERISA plan is preparing an investment policy statement. An investment included would probably be, I would probably use process of elimination here. We're not going to tell you the specific security selection. We might tell some mandate on, based on ESG, what we will or will not buy, but I don't think it's going to have 1 in it. I think I would have got rid of 1. The methods to measure our performance sounds pretty reasonable. And 3 is certainly something we need to be aware of, determining future cash flow needs. We need to know whether our pension plan is underfunded or overfunded. So certainly we're going to need that. Let's see. So the summary plan. No, the summary plan is a different document. That is a different document. And so the answer here is B. And again, what I might do is just on these, you don't get a whole lot of aim and shoot, but on these aim and shoot point click questions, maybe I get rid of 1. And, maybe I highlight. You don't want to highlight like answer sets. You want to highlight, or, have a poor man's flashcard that tells you what you need to know about a particular topic. And so what we need to know, the takeaway is not that this is B, that it's 2 and 3 are the truthful statements. An investment advisor representative prepares a detailed portfolio restructuring for a new client. The client is not impressed with the recommendation, and at least to the investment advisor rep, it appears the rejection is more due to a lack of understanding than a valid dislike. What should the first step taken by the investment advisor be? So again, prepare a new set of recommendations that will hopefully be received more favorably. Man, that sounds like an easy way out. Let's see if there's anything better. Go ahead with the recommendation anyway. You should have been able to toss that out immediately. Right? I mean, you need to follow the customer's instructions, and, unless you have discretion, maybe then it says here, you prepared a detailed portfolio restructuring and you made a recommendation. So the assumption is you don't have discretion, because otherwise you wouldn't be maybe having this discussion. Anyways, I don't like B. Suggest that if the client will not follow the rep, should find another firm, maybe not as a first step. maybe at some future step, that's what we have. We have that conversation. D, attempt to educate the client. That sounds reasonable. Yeah, I like that. That sounds like the most reasonable choice there. Too long to be wrong. Sometimes the answer that's too long or is longer than the other answers is the right answer. I call that test taking trick. Too long to be wrong. In the course of a bankruptcy, the asset that backed a secured debt is liquidated, but it doesn't pay off all the debt holders. What happens to that? Well, in that case, you become a general creditor. Now, I wouldn't worry about this as a test issue, but you should definitely know senior to junior or junior to senior in terms of secured bonds, unsecured bonds, preferred stock, common, junior to senior, or junior to senior, common, preferred, unsecured, secured. 78, don't you love the terminology, the remainder man? The remainder man. An agent of a BD sells unregistered common stock to an insurance company. So an insurance company is an institutional investor capable of protecting their own assets. I have no office in the state. According to the Uniform Securities Act, it is going to be allowed. Now, why is it allowed? Because it's an exempt transaction, because I'm selling to an institutional investor. Institutional investors are capable of protecting their own assets. Insurance companies, other broker dealers. This is very much a test question. You know, when I annuitize, I tell the insurance company I want to be paid for my life and my life only. My life and my life only. That will generate the biggest check. And that is very much a test question. You know, because I say pay me for my life and then my spouse for the rest of her life, then the check's going to go down. An investment advisor delivers an investment advisor brochure at the time of contract. According to the Uniform Securities Act, this would be prohibited. Well, no, giving somebody a brochure anytime is not prohibited. Allow, provide the client is given 48 hours to cancel the contract. No, that's not canceling. That's where I got to deliver the brochure. Prohibited because it must be delivered at least 48. It doesn't have to be delivered. But if I don't, then I have to give you 5 days. So the answer here is the D. Whoop. Ooh. The CEO of XYZ offers securities of his company. So he's an agent of the issuer to the public and his employees, and he receives remunerations. Don't you love that? I'm not sure if Brian spelled that correctly, but that's compensation. I'm sure he's a better speller than Dean. Is it remunerations or remunerations? That just means compensation. Now, Brian on purpose is trying to use big words because that's a lot of times people tell us the grammar and the words were, difficult. And I'd be the first to admit that I believe that. I mean, I had a young lady, she's been my favorite student over the last couple 6 months, and she speaks Mandarin as her primary language. And I can't even imagine trying to translate this from English to Mandarin or Mandarin back to English. Oh my God. So anyways, once you receive compensation, you're going to have to register. And it looks like he's an agent of the issuer. So 82, the answer is going to be A. An agent overhears that XYZ will report negative earnings this quarter. According to Aspen's statement on policy on ethical behavior, the agent may, that you're in possession of what sounds like to be material non-public information. So you better not do anything. A state registered investment advisor is acquired by federal government. It doesn't matter. It does not matter. It has nothing to do with answering this question. This is very, very testable. You have to have written consent to assign an investment advisory contract. That is very much a test question. Very much a test question. Now, by the way, be prepared for a question like this where it's a partnership and I own 30%. I'm a minority partner and a partner retires and I buy 20.1 and now I'm the controlling partner. That's going to be considered to be, again, assignment. So it's a minority partner. I have 30% partner and I buy another 5. That doesn't trigger this permission of the client to assign the investment advisory contract. Very much a test issue. One of your client dies. Who can you take instructions from? Now, I might overthink this because Brian doesn't give me anything about how the account's registered or anything. You should have been able definitely to eliminate C because you should know that all powers of attorney cease upon a customer's death. Durable has nothing to do with you dying. Durable has to be legally incompetent. So, should have been able to do that. A spouse CPA, no, spouse, maybe, but, since there's no other information there, D. Be careful now. Again, there are situations here where it may be a bona fide loan. A bank lends money. And if this is a bona fide loan, I go through the normal loan process. And then I can borrow money from the bank, even though the bank is an investment advisory client. BD's margin account. I have a margin account at a broker dealer. That's again a bona fide loan. What bank and BD have in common, by the way, is they're unnatural persons. They're not living, breathing human beings walking planet Earth. My best friend is a living, breathing human being, not in the business of extending loans. My mortgage broker arranges loans with a financial institution, but shouldn't make me a personal loan. And so now we got to be careful. The question Brian is asking us, in what situations may this be okay, and where it may be okay. Well, I say may because it's got to be bona fide again in good faith, and it's got to be the normal process of getting a loan. C is the answer to 86. 87, an important measure of a company's liquidity is to determine the company's current assets less the current inventory. So current assets minus current inventory is called quick assets. That's the definition of quick assets. And then we divide that, we get the current ratio. I would know these ones. This answer set is there. I don't think you get all four, but you'll get at least one of these. I have this in the 50 practice questions. I think I also have it in the practice test 1. I have a lecture, analytical tools that it's in. Current ratio is current assets divided by current liabilities. Working capital is current assets minus current liabilities. Capital in excess of par, who cares? To split commissions, agents have to be properly registered. And so disclose the arrangement, receive consent. No, you don't need consent from the customer. You got to be properly registered. Reduction of the ridiculous. What would the world look like if we ever get permission from the SEC now? It's going to be 2, and it's going to be 3, which in this case is choice C. One respect in which an LLC differs from an S Corp. Again, you are going to get tested on forms of business ownership. Before I even look at my answer set, I think one thing I'm going to be aware of is that an S Corp has a maximum number of shareholders of 100, and none of them can be aliens. That's one way in which they differ. So maybe that's what they're going to be asking me. An LLC can be formed with as little as a single investor. Yes, we can have sole member LLCs, right? So I told you TestGeek Exam Prep LLC could end up having one managing member, one member, and that would be Brian, or it could have more, but if he wanted, he could have it as a single member LLC. I don't know, none of my damn business. B, there's no statutory number of investors in an LLC. Yeah, we said an LLC can have as many or as little as we want. And we did say there is a statutory limit of 100 on the S Corp. So that one sounds pretty good. There's more favorable tax treatment afforded to members of an LLC. Well, no, both the LLC and the S Corp have a flow through of the tax consequences. So that's not true. The S is no more favorable or not than the LLC. Not only income, but losses pass through the investor. Both losses flow through, right? If there's losses, they flow through. This one I would get rid of. This is recently changed. And what they do on the test, NASA, check their website, but what they typically do is they either remove it or they make some kind of a, dust that. We've recently changed how alimony is. So I would just get rid of that one as a potential test issue. The answer used to be that alimony is reportable income and child support is not, but that recently has been changed. So like I said, I wouldn't worry about question 90 here in the immediate future. Make sure you check, as I said, neither Brian, TestGeek Exam Prep LLC, or Dean's free YouTube channel you're watching are substitutes for your paid study materials. Brian is trying to bridge the gap between, the test and your study materials, but make sure you check your Kaplan dashboard or STC or Past Perfect to see, what the current situation is. Which of the longer we'd have the retirement least tax consequences? Well, one of these things is not like the other. And in a non-qualified plan, I'm using after-tax money. So, I have a cost base. B, C, and D have a zero cost base. Everything is coming out as taxable. Whereas in A, not everything coming out is taxable because some of that's going to be returned of my own money that I've already paid taxes on. And so the answer is A. Which of the following would be appropriate? You should definitely know that life insurance is inappropriate. Art is inappropriate. A municipal bond would certainly be inappropriate in a retirement plan. And so gold coins minted by the U.S. Treasury. Now, I don't think D is as much an answer on the real exam as recognizing that A, B, and C are. Oh, it looks like I forgot to turn over my 30 minutes. I'm not sure where we're at. Sorry about that. I'll assume that we are somewhere around 30 minutes. I'll reset my my timer. You might want to take a break. Now, remember, when you're taking your test, really make sure, ladies and gentlemen, that when you're taking your test and you're getting, like, we're at question 90 here, that maybe you take a mental trip to Tahiti, take a little break, maybe every 35, 40 questions, because you want to be able to finish strong on your exams. When people score high and miss the exam, I just feel so bad. And I think sometimes it's just because they give up the fight a little too early. They get tired and they go, woe is me. And they start, getting their reading skills start to diminish, and, B, C, D, A, and then they miss it by a point. So, gather yourself towards that back stretch and, make sure you finish strong is what I would tell you. I've been at it a while too. So the other thing is, you see something, say something. Very rarely, but every once in a while, Dean misses something. If I do, I have corrected in timestamp. So every once in a while, somebody will send me a comment. Oh, Dean, this one. I said, well, if you're the first one to send me a comment, I go, oh, thanks, good catch, and I'll fix it in the timestamp. But usually, maybe 10 lectures. Every once in a while, I have a brain fart. Brain farts are real, and if you see one, let me know. All right. Well, I'm going to get back because I got to finish this up. I got things to do, so I got to get this thing done. This is very much a test question, 93. The answer is B. And again, we do not want to give up. We do not want to give up aim and shoot, point and click questions like this one. So the answer here is on 93 is B, 72 hours. So 72 hours is very much what we have to do. All right, let me get off my thing here. And again, I love the opportunity for poor man's flashcards. Or maybe I should, tell me in the comments what you think I should call them: poor man's flashcards or lazy man flashcards, or lazy woman flashcards. I had a guy, he made his sales assistant do this for him, and I thought, you're missing the point of making flashcards. Right? So your client has won the lottery and is considering whether to take a lump sum or receive periodic payments. I kind of like this question. This question is getting at, again, what's called the time value of money, right? What is money today worth versus money in the future? And this is a simple math question. So, I think that sometimes we take advantage of people not knowing how to do the math. I'll be honest with you, I'm not very good at the math. So if I won the lottery, I'd call my buddy Lee. Lee is my guy who I hired to do math when I needed to do it. In my practice, sometimes I had to do some higher end math, and I'm not going to do it. I'm going to call Lee, best math guy I know. Say, hey, Lee, crunch these numbers for me and tell me what I should do. Should I take the lump sum, or should I take, the periodic payments? And he's going to say, well, Dean, what rate of return do you want me to assume? As well, I said, Lee, why don't you run it 2-3 different ways, and let's come up with a set of numbers, perhaps. You should know it's not. By the way, you should know it is not holding period return. So holding period return is testable, but that's if I did like a covered call and it was 3 months and I made 10%. 10% is my holding period return. And then annualized, I would times it by 4. You should definitely know it's not opportunity cost. You should definitely know it's not risk adjusted return. And so, you could have got this question by process of elimination. But the answer here is time value of money. Investment policy statement. We talked about an investment policy statement earlier. Provided by the plan must include all the following except, the plan doesn't identify individual securities, right? This is the second time we've kind of had this except question here, right? So I think what I would do here is I would get rid of the except and get rid of the wrong answers. Whoop. made a mistake there. What I want to get rid of is this one and then leave the remaining ones there is what I'm trying to do. So anyways, that's a good poor man's flashcard. The answer there is B. So A is true, C is true, and D is true. A testamentary trust may be only created by one of the following. So you are going to get a couple trust questions, and this is one of them. Again, another great lazy man, poor man's flashcard. Right, that is what the testamentary trust is about. So that's a great aim and shoot, point and click. An investment advisor cash flow is money flowing through. So assets don't show up in the statement of cash flow for a customer. They show up on the balance sheet. And so it's assets. That's very testable, by the way, right? So, I'm going to sit down with my customer and say, for me to do a really good job for you over time, I need to know a lot about you. One thing I'd like to do is create a balance sheet as of today. I'd like to walk through your assets, current and long-term or fixed, your liabilities, current and long-term, to establish your net worth. And then I'd like to look at your income statement, the money you have coming in, your top line, your bottom line, and see if perhaps we can't find some money to deploy into dollar cost averaging, for example. Very testable, very testable. The other thing I'd be prepared for are things that don't show up on the balance sheet or the statement of cash flow or income statement. Like, your age or if you're married, things that are not numbers, that would show up on those financial statements. 3 years ago, a customer bought 200 shares at 50-50. Upon her death, you are definitely getting either a death or a gift of securities. And so she left the shares, her husband was at 68.25. So this is called the step up in the basis. The step up in the basis. So the IRS assumes that she just transferred those shares to her husband at the market value when she died, which was 68.25. Now be careful on the test. If this was not a death, this was a gift. If she gifts the security to somebody, the answer would be 50-50. So make sure you're reading the question carefully. Is the person dead? Here, the person is dead. Or is it a gift? If it's a gift, they assume the cost base. Both those scenarios are very testable. A portfolio manager has a value management style that would seek stocks that have high port value. So you're a smart shopper. As a smart shopper, you're looking for things that are undervalued and would have a higher dividend payout ratio. And so the answer here is going to be 3 and 4. 1 and 2 would be a growth manager. Would typically you have a growth manager. Again, a balance sheet is assets and liabilities and net worth. Income doesn't show up on the balance sheet. That shows up on the statement of cash flow. And so the income statement. Here's another order. A customer enters an order. Sell stop at 45. Now, please note, this is different than the last version. Now, if we pull the trigger, it becomes a market order, not a limit order. The previous, we pulled the trigger. Who knows? We pulled the trigger. We're watching trades go by on CNBC. As a client, what I'm looking for is a trade at or through 45. And then I'm telling my broker I want immediate execution at the best available price. Last time I didn't want immediate execution, the best available price. Last time what I wanted was my price or better if it traded at or through. So we're looking for a trade at or through 45. Boom. Gets triggered. It's now a live market order and I want immediate execution at the best available price. And so it looks like the best available price is going to be 45.28. Over the past 5 years, an investor's portfolio has shown returns of 6%, 4%, 11%, 10%, and 4%. Which of the following statements is true? I like the mean. To me, the mean is the simplest thing to figure out when I get one of these questions. And remember what the mean is just the simple average. So I'm going to, where's my calculator? I'm going to take 6, looks like something we did last time, plus 4, plus 11, plus 10, plus 4, and I get 35. There's been 1, 2, 3, 4, 5. I'm going to divide that by 5, and I get 7. So the mean looks like it's going to be Roman numeral 1. And that's not too helpful. It's not too helpful. Oh, I can eliminate 3, right? Dean can eliminate 3 because I just said the mean is 7, so it can't be 4. So I can eliminate anything that has 4 in it. Let's see if that's helpful. Right, it can't be both, 4 and 7 in the same universe. That's called the principal mutual exclusion, right? We can't say that this is true and at the same time that is true. That would be impossible. So now I got to decide, am I saying the median is 6 or the median is 7? Again, it can't be both 6 and 7 in the same universe. So, as a test taker, I go, well, I can't take 2 and 4 together because that just doesn't work. So by process of elimination, I can say it's got to be that, right? So let's see if I'm correct. I'm just using process of elimination because 2 and 4 are different things. So remember the median is going to be the middle number. As many numbers as above as below. So let's see, above and below. Yeah, it looks like 6, right? We got 2 below and 2 above. So I just proved indeed that is the case. With regard to margin accounts, which of the following are accurate statements? Initial margin is the amount required under Reg T when a security is purchased. That's indeed true. It's 50% presently. Maintenance margin, what you need to maintain your account is set by the SRO. Yes, that's 25% long, 30% short. So I need something with 1 and 2. 3. A mixed margin account is one in which there are both long and short positions. That too is true, 1, 2, and 3. Margin accounts use leverage, and that too is true. And so the answer is C, 1, 2, 3, and 4. One of your longtime advisory clients is in the intensive care unit at the local hospital, unable to communicate. You would be able to accept orders from the account. Yeah, I like what Brian's getting at here. A durable power of attorney does survive you being legally incapacitated. In this case, you're in the hospital, you're unable to communicate, and I still have if I have a durable power of attorney, I can still make decisions for you. If it was non-durable, I wouldn't be able to do that for you. And then remember, they always cease on death if a customer dies, and durable doesn't have anything to do with death. It has to do with legal incapacitation. 105. Because of liquidity issues involving holdings, most country funds are, this is testable. Listen, 65's test takers, I can't stress to you. We teach the 65 as either a 3 or 4 day class, depending on, the version of it. And I was teaching a 65 that was a 3-day version, and we do mutual funds the last day, and this person was testing on that day and was missing class. And then she called me and she said, Dean, you never talked about open-end, closed-end funds. I had 3, 4, 5 questions. I said, well, I didn't talk about it by way of reminder. Good, and she passed, but you weren't there for the 3rd day. And then today is the day we talked about that. So make sure you understand the distinction between an open-end and a closed-end fund. Closed-end funds trade supply and demand. Open-end funds trade continually offering new shares. I have a beautiful slide. I have a 2-hour mutual fund lecture. I'm almost positive it's in the 65 playlist. It goes over mutual funds, ETNs, ETFs, all that stuff. I also have it as part of the explication that you find in your 65 playlist, but make sure you can do that. That's very testable. UITs are assets are professionally selected, but passively managed. D, there's no test question about holding companies, but what kind of tax return does an estate file? They file a 1041. Which of the following share classes contain a different contingent deferred sales charge? Be careful. Again, lots of mutual fund questions. So, Class A shares, remember, have typically a load, and they have breakpoints, and they have a letter of intent. Class B have the contingent deferred sales charges. Class C typically have promotional expenses. So, make sure you have all the, there's not many pockets on 65 that have 5, 6 performance opportunities. One of the challenges on 65 is there are lots of onesies and twosies. But here, there's an area to make 5, 6 points. Again, I don't know how much work you want to do on options and futures and all that stuff, but they're alternative to investments. Yeah, to be honest with you, I actually like, now that I look at this answer set, they derive their performance from the underlying. They derive their performance from the underlying. And so I just think that A is a better answer than B. So I'm going to change my answer. That's usually not a good strategy, but I'm going to change my answer to A because I think that's better. Alternatives would be more like actually owning not the futures, but the soybeans themselves. So I'm going to change my answer on 108 to A. Defensive stocks are very testable. Defensive stocks are stocks that are resilient to the business cycle. Very testable. And utility stocks, regardless of the business cycle, you need your power. Nobody ever says, hey, I want to go back to the Stone Age. Auto stocks, you can delay purchasing a new car. That's cyclical. Home building is cyclical. High tech might be secular growth, but it's certainly not defensive. So very much a test question. A defensive stock delivers products and service resilient to the business cycle, and a utility stock certainly does that. So here you want a specified price. Which of the following orders would be a specified price? So remember, when we're using a specified price, that means you want your price or better. Your price or better. So I want to buy it at my price or less, or sell it at my price or more. And so the answer to 110 is going to be 1 and 2. So you would use a limit order. Let me clean that up. 1, a buy stop limit. Once it trades at or through the stop, I want my price. Key point here, acquire means I'm buying, right? So it's going to be 1 and 2. If it said dispose, then it'll be 3 and 4. So kind of tricky. That one's kind of tricky. 1 and 2. You're definitely going to get tested on the distinction between an ETF and an open-end mutual fund. It's going to be there. It's very high probability. So the whole point of ETFs is we're created because there's things that people don't like about mutual funds. Let's look at our first one here. They are redeemable securities. That is not true. They're very much a test question. Unlike open-end funds that are redeemable within 7 calendar days of redemption request, no, ETFs trade supply and demand. That is not true. This is very testable. Know that that's true about ETFs. They are designed to track an index. They are designed to track an index. That too is true. They try to diversify within a particular industry. I really don't have a 2, 3, and 4 based on this. My best answer is A. I would also know you can purchase them on margin. You can't purchase an open-end mutual fund on margin, and ETFs you certainly can. ETFs are not buying and selling securities, so they typically have lower transaction costs, and they typically are more tax efficient. They are more of a trading vehicle than a long-term investment vehicle like a mutual fund. Again, very testable to be able to compare and contrast an open-end fund with an ETF. All the following would create a credit in the balance of payments. So credit means money coming in. For example, Boeing selling planes to Japan. Our Japanese friend are going to give us the yen. That's a credit to the U.S. balance of trade. Money in. So question 112. Dividends paid to foreign investors. No, that's U.S. money leaving the U.S. U.S. customers buying foreign cars. No, that is money leaving the U.S. Foreign investors buying U.S. stocks. Ding, 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 ding. Right? Our German friends or Japanese friends or British friends buying U.S. securities are going to turn their British pounds or euros or yen into dollars. So the answer is C. Now, you are going to get economic questions on your 65. I have, you're not surprised, a great economics lecture called Money's a Giant Floating Crap Game. And that's a narrative lecture on economics. I also, within the explication of the 65 test outline, have some more economics there for you. And my economics lecture is spot on as it relates to 65. Page 1, or question 113. Which of the following statements would likely be true of those who are most interested in fundamental analysis? So to say you're a member of the religious rights does not mean that you are, a member of the religious right or you're a fundamentalist. It means you like to look at the balance sheet, right? So interested in fundamentals. Which of the following would likely be true? Are more concerned with short-term trading? I always think when I think of fundamental analysis, I think of Mr. Buffett. Not concerned with dividend returns. They are. Would focus on price to book. Boom. Looking for value. Technical analysts use charts. They use charts to determine more demand than supply, not of a company's product or services, but the stock. As a technical practitioner, more demand than supply of the stock goes up. More supply of the stock than demand for the stock goes down. So I'm interested in, again, pricing, volume, stuff like that. Resignation of the CFO? Nope. Book value? Nope. There we go. Charts. The resistance level is the top line. So as a technical practitioner, I would put a buy stop above the resistance line to go long. And then the bottom line in a chart would be the support line. And maybe I put a sell stop there. As a technical practitioner, I don't buy it when it's stuck within a trading range. C. All the following are considered economically defensive issues except. So I think I need to wear clothes. I think I need to eat. And if I'm a smoker, I need to smoke. I don't think I need to build a new house. By process of elimination, I think that is going to be cyclical. Right? Sometimes people say tobacco stocks are actually counter-cyclical. 116, a married couple in their early 40s is planning to buy a condominium. They need a safe place. Keyword, safe place. To invest the down payment for 6 months. This is very much something you could expect to see on the test. You know, somebody needs to park their money short term till they deploy. The one they like on the test is one of your clients gets relocated to a new community, and she says she wants to rent an apartment till she, does some more exploration of the neighborhoods and going to buy a house in like 6 months. So it's kind of a version of this question Brian's showing here. All the following statements regarding 529 plans are true, except. Well, the 529 is the state plan that I'm going to use to fund. I'm coming to you from Nevada. And so you're not using money on the federal level. It's pre-tax. You're using after-tax money. So A is not true. Anyone can make the contribution. That is true. Earnings accumulate tax-free. Yeah, that's for qualified. Yep, that's true. D is true. There's a phase in on the cover deal, but the question isn't about a cover deal. When comparing ETFs to ETNs or ETFs to mutual funds, again, very testable. Some of features in ETFs are not found in mutual funds would include, I like this question. Correlate to a specific index. Now, we have both mutual funds and ETFs that do that. You can't sell short an open-end mutual fund because, again, this idea of no margin. All short sales must be conducted a margin account. And you can sell short an ETF. We said ETFs can be bought and sold at our margin. So we need a 2, we need a 3. It represents entire portfolio. Well, that's true of both. And so the answer here is A. That is very much a test issue. So let's just repeat. Very testable, be able to contrast open-end and closed-end funds. Very testable, be able to contrast ETFs with mutual funds. So that's a big, basket of questions. You're definitely very high probability going to get something about ADRs. I can't imagine any draw of your exam in which you don't get an ADR question. They are issued by large domestic banks like State Street Bank and Trust or Bank of New York. That is indeed true. They're issued by foreign banks. No, what I'm buying is a foreign security. They facilitate U.S. trading. Yep. They facilitate foreign. No, it's 1 and 3. The answer is C. I'd also know you have foreign currency risk. And I also know this idea about negative correlation, perhaps. Which of the following would an investment advisor rep, that'd be you, use as a basis for recommending an investment in a limited partnership? Well, limited partnerships might have tax benefits, but basis, you better not be lead with taxes. You can't let the tax tail wag the stock investment dog. So the IRS comes a knock and you better said, I hope I was going to make a lot of money and pay taxes someday. You should definitely be able to eliminate ease of liquidity because it's very testable. You can't get in or out of a partnership without permission of the general partner. right? So this is just nonsensical. So maybe I wouldn't struggle with A and D. But D is too long to be wrong. I'm joking, but D. 121, all the following would be considered fundamental analysis. Well, 1 is technical analysis. 2 is technical analysis. Liquidity ratios are balance sheet stuff. That is indeed fundamental analysis. Whoop, got my wrong highlighter there. And historical earning trends, that too is going to be that. And so let's just go back and see what we're asked. Which of the following is fundamental analysis of a security? And it looks like our best answer is going to be 3 and 4. There it is. I apologize. It looks like when I blew this thing up. Again, I may have asked that. If I'm repeating myself, I apologize. But could in the comment box, just let me know if are you accessing my channel on mobile, or are you watching this on your desktop? I've been told, I don't know, like I say, I've been told that over half, and I'm not sure if my channel meets this, because I think that what we're doing is a little different than other YouTube channels. But I've been told in general from both YouTube itself and YouTube people who know about YouTube, I certainly don't, say that over half of the folks that are accessing the YouTube channels are doing those through their mobile device. Hence why I try as much as possible on thumbnails and on this kind of stuff to blow it up. You know, God bless you if you're on the bus trying to watch one of my videos as you go to work. God bless you. But that's my point. I'm sitting at a nice 27-inch desktop screen, so that's an entirely different proposition. Anyways, 122. The offering of unit investment trust would be regulated under, you do get a UIT question or two. And I think the UIT question is usually about the assets being professionally selected and then passively managed. I don't have here anything about the Investment Company Act of 1940. Given this answer set, I have to say 33, right? Because I'm selling brand new securities to the public. So the answer there is D. D. Yeah, by the way, that means you can't buy it on margin, right? Because it's a new issue. An investor would like dollar amounts of varied asset class to remain constant in order to remain fully diversified. Boy, I'll tell you, when Brian's trying to be a jerk, he is really a jerk. Now, this would be very easy for me to misread this and say that this is dollar cost averaging rather than what it is, which is rebalancing. So the answer to 123 is B. 124, an investment advisor rep prepares a detailed portfolio restructuring for a new client. The client is not impressed with the recommendation, at least to you, the investment advisor rep. It appears the rejection is more due to a lack of understanding of valid dislike. What should be the first step taken? I think this is similar. Maybe he rotated the answer set. Looks like A, attempt to educate the customer. Yeah. I think, by the way, this happens. People on debrief tell us they had the same question asked twice. And I think this is Brian asked this question earlier, and I think it was the D choice, and now it's the A choice. I think he's trying to trick us. Well, I shouldn't say trick us. I'll say it this way. He's trying to stretch your mind and hope it doesn't go back to the same spot, right? So under the Securities Act of 33, all the following materials may be distributed to a prospective customer concerning a new stock offering during the registration period. I think what Brian is getting at here is what's called the cooling off period. And during the cooling off period, we can send a preliminary prospectus. By the way, those are the same things, preliminary prospectus, red herrings. We can place a tombstone. We can accept indications of interest, which are non-binding on all parties. And so A would be a violation here. You're not supposed to accept that. Under the Uniform Gifter Minors Act, a custodian may re-register assets to the minor at the age of majority of the given state. Now, remember, that's the difference between Uniform Gift to Minors Act and Uniform Transfer to Minors Act. An agent recommends a tax-free. By the way, I'd also know in that both of these, the kid's tax ID number goes on the account, no margin, one minor, one custodian per account, very testable. An agent recommends a tax-free fixed income security to a customer based on their tax rate. The customer believes another taxable investment would give them a better return. The agent should compute the equivalent yield. Listen, I'd be able to do this math. I have, again, and I'm just, the channel has evolved. We're going into our second year. And I know I'm telling you there are things available on the channel. But let me know if in the links, I always timestamp it. The timestamps sometimes are pending, particularly on this thing. It looks like we're going to be going over an hour and a half, but I do timestamp it and you can find things there. And, I can actually link into the timestamp to where you can find a little 10-minute thing on how to do this math. And if you think that would be helpful, just let me know and I'll start linking. That's our timer telling us it's been another 30 minutes. We got a couple more questions, so I'm going to go for it. Let me know what your thoughts are on that. Brian's not asking you to do the math. He's just asking you to recognize the math here. But I'm telling you that on the test, I'd be prepared to do this math. So it's going to be the tax-free yield by the complement of the dividing. You're either going to multiply or divide, by the way. They're always going to give you the tax bracket in the test question. And you're either going to divide or multiply. If they give you tax-free, you're going to divide. If they give you a taxable, you're going to multiply. So make sure you can do that. That's very high risk on 65. That not only do you recognize it, but you can do it. An investor age 55 seeks a conservative investment with moderate income. She's not experienced. She does not like risk. As an agent, you most likely, it sounds like I'm going to have to be very careful with this person. And again, I don't really like the answer set. A demand deposit is a checking account. That's what that is in English. I know C and D aren't there. So given this answer set, I'm eliminating C and D, and I'm going to go for the money market versus the checking account. Rates are starting to go back up, and money markets haven't been competitive from an income standpoint in a long time, but they can be, particularly in a rising interest rate environment. Under the gift tax marital deduction, so this is a gift between spouses, and a gift between spouses, it's an unlimited amount. Indeed. Which of the following is not associated with passive investment approaches? I like this one. This is kind of a good one. Goal of beating the market. All right, so as I say, let's just review here. So as you can see here, if you go ahead and buy the PDF, you would get the PDF of the exam we just completed. You would get, that would be $24.95 from TestGeek Exam Prep LLC. With our 20% discount, that would be $20. For $49.95, you get the PDF of the practice exam, the answer key and rationale, and you get Brian's quick notes, which charts and cheat sheets and all kinds of great stuff. With the discount, that comes in at $40. And then by far the best investment is the full paid supplement for 65, which includes the videos. I'm sure you probably have found or can find reviews on Brian's videos, but I'll again link to those and you can check out the hours of videos he has on 65. I think I'll probably link to his 65 intro video on YouTube. Why not? Right. I hope you found something worthwhile in the explication of this practice test number 2 and the 65 playlist. If so, please let us know, because I spent a lot of time, and if you aren't going to hang out and do these with me, then there will not be a practice test 3. Right. But if you find these productive, at some point we'll roll out practice test 3, whether it's Dean or Brian. Practice test 1 in the place that is from me. This practice test 2 is come from TestGeek Exam Prep LLC. Please share the channel. If you're taking your 65, my guess is perhaps maybe you took an SIE, maybe you took a 663. And so please let the people you know at your firm who are starting earlier in that testing journey about the resource of my channel. I would appreciate those referrals. Love referrals. We're over 300,000 views just starting our second month of our second year. So we've been at it just a little over a year. We have over 4,000 subscribers, and most of that is coming from test taking victories and referrals, and Google doing its part, picking us up in their algorithm. So like, share, subscribe. I'm going to release this Tuesday, 3 p.m. That's when we always do uploads, Las Vegas time. I'm there for a chat along while this is premiering. I get there 15 minutes early, and that chat is for everything, whether it's 65, 66, 6, 7, any FINRA, any NASA exam. Okay, test takers, Stay dedicated, stay disciplined, stay organized. You got this. And bon chance, mes amis.